What up guys, so in today's video we're going to be talking about how you can be selling covered calls and basically what is a covered call. So first we pick a stock, a good stock, a valuable stock that, a blue chip stock that won't just disappear in the next day. So then we go to trade options. All right, so usually you're probably used to just buying a call, right? Basically if you buy a call, you're saying that the stock price will be at the certain strike price by the time it expires, and if it's not, you lose the amount of money you paid for it. That's basic and that's simple. But selling a covered call is you're the one who is selling it. So if I were to buy it, I'm buying it from someone who's selling it, right? But if you were to click sell a call, right, you sell it, so you collect a credit. So this would be $202 that you would immediately pocket. It would go into your buying power and you can take it out and you can go buy some shoes or whatever you would want, or you could buy some more stocks, which would probably be the smart thing to do. But there's a catch. So let's say you sell a call of Apple, a $400 at a $400 strike price, right? First, you need to have 100 shares because you are selling a contract to someone. You are selling the rights to 100 shares of Apple at a $400 strike price if it happens by July 17th. So if by July 17th Apple is at $400 or above, right, they will take your 100 shares of Apple and sell it. So that is basically what you are risking. The reward would be if Apple does not close at above 400. So basically when you sell a call, you don't want it to be near that. You want it to be underneath. Because if if this contract expires worthless, well, guess what? No one exercised it, so you keep the credit. You keep what you sold it for, and you get back your shares. You get back your 100 shares. Now, of course, doing this with Apple would be fairly expensive because you'd have to own 100 shares at $391. That'd be like $39,100 of potential collateral, right? But I don't know if Apple will hit 400. The market's been a little weird lately, so it could run up to 400 by July 17th, which is in like 3 days, this Friday. So it is possible. But now let's talk about why you probably shouldn't sell it at around this price. The reason you shouldn't sell it around this price is because it's a lot more likely to hit this price. And let's say Apple shoots up to like 395 and you have to sell out at 392.5, you'd be losing $2.5 per share. So you'd lose $250. That's how you lose the money. And the thing is, it would kind of be worth it maybe because you made $408 and you lost $250. So you'd still be in the green a bit, but it wouldn't really be worth it because now you don't have 100 shares of Apple. And let's say it just continues to rise, it's just going to multiply the more money you're going to need if you ever wanted to get back your shares. So the whole strategy relies on not wanting to give up your shares, using them to make yourself some extra money. How you could use that is you can choose something that's far out of the money. 420, haha, 420. You can sell that and more than likely it's not going to hit. But that's why the credit that you receive, the premium you receive, is so low because it's not likely to hit that price, right? So then you can also do this with further out expiration dates like July 24th, and you will collect more premium. And the reason you collect more premium is because there's more time on it. It's more likely to hit that price. So you collect more money for it. So if you sell it for 20 for next week, July 24th, you'd get $201 immediately into your account. But they would take 100 shares of Apple as collateral. Now, of course, it'd be too expensive, like I said, to be trading covered calls for Apple. But you could be doing this type of strategy with another stock. Let's think of another stock such as Bank of America. So Bank of America is currently trading for $24, and if you have 100 shares of Bank of America, that's only like what? That's only like $2,444 or something, right? So you could definitely, if you have a smaller account, you could definitely buy 100 shares of Bank of America, and then you could just scroll up on the markets chain. Of course, it really wouldn't be that worth it because I mean, you would collect $9 of credit if you were to sell this call, and I guess it could be worth it if you don't think it's going to hit $26. And basically when you sell a call, you also are rooting for your stock to go up. If your stock goes up, you make money in your stock wise, right? But as long as it doesn't pass the strike price that you sold, so you have to sell a good strike price that you don't think is going to hit if you want to keep your shares. If you don't really care, that's another thing, but I would aim towards keeping your shares, so that would be possible. You could also sell further strike price for a little bit more, so you could sell that you'd collect $25. So that's it. That's basically how selling covered calls works. If you have any questions, let me know in the comments. Again, this is a small channel, so I'm more likely to answer any questions you have in the comments. Make sure you like the video, subscribe for future content, and that's been it. Peace, guys.